Hello, traders. I trust you are all well. Welcome to Live Trading Profits this Wednesday. So, as we start, just a reminder, next week, second Wednesday of the month, is that beautiful day that we have 4 hours in the market with George. So, I have scaled down the Wednesdays at the market from 8 hours to 4 hours, and we primarily trade in just the opening sessions. Asian Open, European, UK Open, and then we finish off with the open of the US market. So really exciting, and I think 4 hours is manageable for all of us. Now, so I'll put up the links there on the Actions to Wealth page, but I'll put up the links just before we close so that you can register. So the second Wednesday of every month, absolutely free of charge to yourself. I think it's great education. Of course, if you want more, the third and fourth are all exclusive to my private clients. So what I've got, 8 markets that I'm trading, 8 stock indexes, which represent plus or minus 1,450 of the top and the largest publicly listed companies in the world. So a fair reflection of what's happening in the business world. Now, guys, just because I don't have any of the charts that you are trading up here, remember markets are fractal. So the patterns that you see on any chart will repeat themselves on any other chart and any other time frame. But if you have a particular chart that you're looking at that you want me to pull up very quickly, currency, commodity, we can just slap it on, have a look at it and discuss it. Another thing that I'm going to do more and more going forward, I think you're all getting used to my trading style. I prefer to take trades, reversal trades that give me the opportunity to build positions and extract as much wealth as possible. I'm not very keen on scalping, in other words, going in and out of the market, taking 20 trades in the day. Some guys can do it, but what I'm going to be doing is showing you trades that you could have taken. Then you must decide whether that's, you take a trade there or you'd wait for a different kind of trade. So, first chart we're looking at, top 50 companies across the Eurozone, Euro Stocks 50. So if you are in the market, right from the open, and guys on the east side of Africa. Africa is at the center of the world, as you know. So if you're on the eastern side, going towards the Asian subcontinent, you'd have been easily trading these markets. If you're on the western side, you then come through on the come through now, or probably the US markets. First thing you always do, very, very important. First candle of the day, I've just marked it in yellow. Bulls in control. Now, if bulls have control the first candle, as the day unfolds, just always be aware that you might get bullish price action. But the second candle presents a problem for the bulls, because if the bulls are strong, why do we have a bear candle? So again, alert bells going off in your mind. Then we get a 3 push pattern, wedge pattern. Nothing for us to do here until we get confirmation that the bears have taken control, because it could just simply be a pullback to test the 10 EMA and then the market accelerates up again. So you don't want to jump into that trade. Even if you're pretty fast, I wouldn't do it, because it can bounce off the 10 EMA and before you know it, you are into a losing trade, and then you don't have to jump in and I'll just wait for confirmation. So when I see that kind of pattern, I want to wait to see if I get pullback and lower high. We didn't get a lower high here. The market sold off quite strongly, so good for the bears. Bears were much stronger here than the bulls were here. Okay, so same kind of elevation, if you like, wedge pattern by the bulls, but just a strong sell-off by the bears. So bears are strong, so you ought then to be looking for pullbacks and opportunities to trade. So first leg, pullback, this is enough opportunity for you to trade. If you take a trade there, stop's going to be up there. So you got to decide, do you want to put a stop up here or not? Why would you put a stop up there? Well, because we might get another push up to test that level. So If that happens, one of the questions that guys tend to ask is, hey, hang on, my trade is going out against me. That's perfectly fine. That's why we put a stop in the market. That's why we decide the technical place to put our stop. So if you take a trade here and it goes against you, perfectly fine. Hold on to it because your stop will be in the correct place. Okay. In this case, it didn't. We had acceleration, great for the bears. Now, if you're a bear, if you've seen that, you're probably saying, okay, there is the breakout from there to here. Measured move is here at the 200 level. So if you're a bear, you kind of hoping the market gets down here. Okay. Now, we're the first leg, pullback, second leg, and the market didn't get down there, it turned. So you always have a choice. Okay, if you want to maximize your profits, then you gotta wait until the market gets there. Okay, if you're saying, why is the market turning before it goes there, wait for the moving average, you turn again, the bulls continue, you're quite right to come out above any of these bull candles here before you get to break even. So you can do that because you're saying, well, something wrong with the whole thesis here. The bears should have carried on the selling. So if you held on or you had to go away for some reason, put your stop here and say, well, I think it's going to get down there. You'd have taken your profits here. Fantastic. But if you exited because of this reversal, you wait again. You don't jump into a bull trade immediately on reversal. You have to wait to see the strength of the bulls. This is saying to you, trade management, probably wise to get out of any trades if you want to hold on to them. So you get out just few, fractions of percentage, but they break even. Then you get a double top. So here we had a lower high. I have a lower high double top. Perfect opportunity to jump into the trade again. The good thing about this particular trade compared to this one, when you took the first trade here, your stop is going to be up there because there's nowhere else to put your stop. Oh, I say there's nowhere else to put your stop. Remember, I always say look for the 50% pullback, but we are already at the 50% pullback. Okay, so that's a very tight stop you could put there. High chance of being stopped out. Best stop is there. But if you take in this trade, lower high double top, then you can put your stop up here. So it's a much tighter stop because the bears that created this lower high and that lower high should defend that. If they don't, you don't want to be in the trade. It might just accelerate up. So if you take that objective, get down here, pull back. So you see this little pullback here, that's bears taking profit. Some bears say, I've gotten to the point that I want to get to. So I'm not going to hang around to see if there's more. So this pullback is just profit taking. Does not mean that the bears have lost until we start to take out these lower highs. That's the only time you could argue that the bears have lost. Okay, but bears that didn't take their profits, acceleration, they want to get to the measured move. There is the measured move they want to get to. Okay, a couple other measured moves that you can look at. So there is one for the breakout. Okay, there is a breaking out beneath that. Measured move is here. That's where we got to. But another trading range was formed here. So you could also say, what's the measured move of that trading range? That low, that high, the 200 point. I mean, the perfection of these measured moves, if you're not yet converted to measured moves, you got to be thinking about it because they're so precise. So these bears who didn't take a profits here, looking at this trading range and saying, well, we're going to wait and see what happens. So we get to that measured move, profit taken. So absolutely perfect place to take profit. So if you're taking that trade, that's probably a 2-to-1 or 3-to-1 trade. If you'd held on to that, you'd have that trade. It's probably less 1-to-1, but still profitable trade. Could also take another trade here if you wanted. Only if you're taking a trade here, breakout pullback, your stop has to be above here. This is a breakout. You can put your stop above there. Breakout pullback. So bear breakout, pull back, there's another trade you take, you put your stop here. So you could still, if you haven't taken that, you can take that trade or that trade. If you've taken that trade and want to build a position, because by the time you take this trade, that's a break even, you can add on here. Okay, if you've taken that trade, there's no point taking that trade because you're already in at the same level. The only way you could take these two trades, if you took this trade with a stop up here, and then you see this setup and you know your stop has to be here. You need to pull your stop down from here to the correct level. So that probably takes out maybe 2/3 of the risk. So essentially you're risking 1/3 of your whatever capital. You can then add the other 2/3 here so that your overall risk on both these trades, if you get stopped out, still remains the risk that you're comfortable with at the beginning. So that you could do, but you need to have determined where the stop should be, put your stop ins, and make sure the total risk is the same. Then when you get to break even, depending on how aggressive you are, you can add in. I'm very comfortable adding in as the market is breaking out and building a position. Now we get here, profit taking. We're still not certain at this stage if this is the end of the selling. The bears have reached their initial objectives here and here. So it's very hard for you to reverse if you've just taken profits. If you're not in trades and you're waiting and wondering and you see this, you thought maybe there'll be a little bit more to test the high of the trading range. So if I see an acceleration, I can buy above here. This, as it turns out, would not have probably allowed you to get in because there's a bit of a gap up. By the time you place the order, etc., is gapped up. Okay, but if you're a scalper, you see a bull candle closing on or near its high, you just buy at the market, and your goal is to get to here. So when you see that reversal, you kind of worry a little bit, and you wait to see what happens, then you can accelerate. But I didn't show that because that's, I think, a little bit not tricky, but not necessarily this stage. Okay, there's more ways to make money. Now, we then get a double top. So if you came into the market, you didn't take any of these trades, or you've taken some trades, or you've been waiting to say, hey, this is just not clear. I mean, if you had a look at, yesterday was a beauty of a day. Look at yesterday. Gap up. Okay, these are today's lines, so ignore them. But this gap up was close to the high of the previous day. Yeah. So this line that I have here, although it pertains to a major move for today, that was almost the high of the previous day. So gap up, you said bulls are strong, follow through, fantastic. But then we create a trading range at the high of the previous day. There's wedge patterns, there's lower high double tops, then there's a breakout. As clean as it comes, when you see that, you got to start selling. Okay, sell. If you didn't sell any of this, you wait for the pullback and you continue to sell. Now that's when those days come. If you catch them, you must just capitalize. Today is a little bit more complex in terms of what the market is showing us, but if you are patient, it is still tradable. Now, what I'm always saying to the guys, if you miss trades, don't worry about it. Okay, there's always opportunities. When I do my analysis, I go back and I say, oh, George, you could have taken that, or maybe not that, but it doesn't bother me because there's always opportunities. So if you missed any of these trades, do not worry about it. You gotta wait for the next opportunity. So you see a double top and you say, okay, I see a double top. Where do I jump into the market? Now, remember when I talk about patterns, see the pattern first and then wait for the execution. Okay, so there is a double top. You'd want to wait for the breakout and a pullback and a lower high. Okay, pullback can occur anywhere within here. But when you see it, then you can decide whether to take the trade or not. If you're not comfortable with that particular trade, you wait, let it go, wait for the market to come back and give you a clearer lower high. It will come. I would not even stress about it. So if that, because it looks like we're in a trading range day. So the bulls break out above this little trading range, that's their measured move. So you might get your lower high being formed here, and if you're more comfortable with that, you take that particular trade. So there's absolutely no need to rush. Just like in here, you'd have seen breakout pull. They say, I'm not happy with it. Let me wait for it. You know, this would have 5:15. So this is almost 2 hours, but you get a much better, much tighter entry for you to execute. So don't ever feel pressured to take trades. So you might say, well, George, what if I want to take a trade right at the double top? Okay. If you want to take a trade right at the double top and you've seen that you think it's worthwhile, well, you know the basic rule, you got to find the measured move. So you got to look at it and say, if there's a breakout above this double top, to what extent, where is the measured move? What is likely to happen? So you can see bulls broke out above this high, they broke out above that. Okay, a bit of, it's a follow through, but very weak. Pull back. So if the bulls are strong, they want to do a measured move above that. So if you really want to take that trade, you got to go away, or you just got to take a trade for whatever reason. If you're taking that trade here in the double top area, double top with that, your stop is going to be up there. Okay, why would you do that? Well, because the bulls might just say, okay, created a double top here, fine, but we have enough strength. So they could have been follow through of that candle. And the bears would have had to come out and reverse it. So if you're taking that trade at the double top, before you get the confirming entry, which will be a lower high here or anywhere else, then you need to put a measure move stop. When you're now taking that entry, tighter stop. If the market comes back and gives you an entry here, much tighter stop. So point is, there has to be absolutely no reason for us to be compelled to take trades. So you could do that, put that measured move and just wait and see what happens. There are plenty of opportunities there. Euro stocks, I will come back to that. Let's just pick Aussie 200 and see what opportunities that have given us. Okay, so first candle of the day. Market closed here, kept down. At some point was a huge bull candle, then fell. So it's a high test candle, then an inside candle. So already that's showing that the bulls are in control, but there's a problem with the bull case. Okay, the bulls are strong. Well, you know, after the gap down, they gave us a bull candle. Why were they repulsed? Just get a high test candle. They came back with an inside candle. Why do you still have a tail above that? So there you should be starting to raise questions about the strength of the bulls. Now, that's trading range price action that we have here. Okay, market has gone up and come back, inside candle, and we still haven't broken above that. Bulls need to do a little bit more, which they did. They came back, gave us a close above that high from US session, which is good. Give us a close above the open of the candle, the open of the day, not the open of the candle. Okay, high of the first candle, low of the first candle, big tail, so it's a trading range. There is a measured move. So they got to the measured move and failed to close above it. They had a follow-through candle. Okay, still bull body, but dodgy. So bulls are strong to give us breakout, but they're not convincing so far until they give us this candle. Now, at this point, you have a choice. You're saying, okay, despite the trading range start that we created here, we finally got a test of it, close of it, and a decent enough candle. That's a trade you can take. The reason I didn't mark it is because I don't like where you put the stop. If you're going to take that trade and just say buy at the market, there is no other place to put the stop than down here. Okay, that's the place you're going to put the stop. Now, I'm not comfortable putting that wide stop, because to get to 1-to-1, there has to be a huge move. We did get to 1-to-1. So if I'd missed that, I would have said, oh, well, George, you should have just taken it. But all the bulls that are taking that trade, I said, okay, I'm just going to take the trade here. I know where the stop is. I'm hoping that to get to a measured move, and to get to the measured move, and immediately there was a sell-off. Okay, so if you're comfortable to buy at the market in a breakout, that's what you would take. I don't buy breakouts. Okay, the only reason I enter into breakouts is after I've built a position in the market. So this had gone up, given me a pullback, and I jumped into the market at the pullback, and then it's gone up, and I've put a protective stop at the correct place, break even, and then the market starts to break out, and I've already banked some cash. Then I can start to buy at the market, small bits and pieces, and build my position. But I'm not going to jump into a breakout trade. It's like when there's news, for example, and we've kind of spoken about it before and said, if there's a news breakout, wait for the breakout and say, fantastic, bulls are strong. Now let's wait for a 50% pullback and see if we get a bounce off, then we can take it to a measured move. That's why when there's a news breakout, I don't just go and buy the close or sell the close, wait for it. But if you come to put that kind of wide stop, by all means, that's the only place where the stop goes. And when you get to there, take your profit 1-to-1, and you're not expecting to get a lot more. Okay, so if you are not in the market and you see that taking place and you get to that measured move, and the market turns immediately, descends enough reversal, you got to ask yourself, now, where do I jump into the market? That's at a hidden level of resistance. We can see where today the high of yesterday is. So you got to try and find a way to get in the market. There is reversal, sideways price action is a pullback, distant enough high test candle, bear candle that you can sell. But if you do that, again, stop, measured move. Okay, so you'll be taking the trade here, measured move, so you have to put your stop above there. Perfect place to put a trade. So that's where you'd probably take your trade. Let's just put that in there. So we're taking a trade off that and putting a stop above the high of yesterday, because we're saying, okay, so the rationale is we're not ignoring this whole bull move, but we're taking into account where the market started. That's why this is so important. Trading range price action here. We had a breakout to test the measured move. And we were thinking, okay, after the measured move, there might be a bit of selling. Bulls fell into breakout, but they had a breakout above a hidden level of resistance. Okay, let me take a step back and explain that a little bit slower. So whenever you have a pattern and the pattern fails, and then you get a breakout where the pattern fails, possibly there will be a measured move. Then you have to decide where to put your stop. So the pattern that we had was at the open, trading range price action, measured move. Whenever we have a trading range and measured move, we're expecting there's a higher probability, 60-70%, that the market will at least bounce off that, come back, and maybe accelerate up, because that's the top of a trading range, okay, hidden levels of resistance. But instead of the market bouncing off, the bulls went above it with this little doji candle, tails above, tails below, still closed above it. And then they accelerated up. So now that essentially is a failure of this measured move. So when you see that, say, okay, we'll probably get another measured move going up. And if you have a look at it, good bull candle, doji, doji, bull candle, doji, huge acceleration to right up to the measured move area. Remember this measured move area here. So when you then see that failure, after analyzing this, you can then take your trade. Okay. And now, of course, taking that trade, you go through the whole process again and say, where are we likely to get? There is a bear trend or bear breakout. And let's just move this. Bear breakout. So we've taken that trade. There's a stop. There's a bear breakout. There's a pullback. You can take a trade beneath here. You wouldn't have been triggered. Doji candle. You don't want to take a candle beneath a doji because that's a 1 bar trading range. So whenever you see a doji candle, be it on the daily candle, whatever the case may be, it's a 1 bar trading range. So you want to see what happens at the measured move of it. Measured move, go sideways and break out. So not much other opportunity for you to jump into the market at that stage. But when you reach the measured move, then you got to make a decision. You've made good enough money off this, pull your stop down to that level. Okay, when the market turns, you can trail your stop to there. Then you got to decide, when to exit your trade because you've reached the objective. Exit your trade. If you want to hold on to it and see what happens for the rest of the day, you can make that call. But good enough profits, take your trade. Now, we now have a lower high double top here. Okay, so that's been created. And whether you've taken profits or not been in the market, when you see what happens, there is a double top. Good enough for you to take a trade. Bear candle, take that trade there or take the trade there. So I think one of the things that I'm hoping comes across, and if we have time, we'll look at another one very quickly. There are opportunities on different charts. And we could open up anything and look for opportunities. If they're not there, you just wait or move on. Now, you don't have to take all of the trades. You don't have to be trades in the euro or the Aussie 200. I mean, just choose one or two. And it can happen that by the end of the day, you'll say, oh man, George should have chosen the NASDAQ 100. It better moves. You made the call, made a bit of money. It's fantastic. Just, don't stress about it. Your psychology is always going to be saying there's always opportunities in the market. The thing that I got to work on is crystallizing my strategies and just taking those trades when they come. And then I just worry about the random distribution of trades. Remember the trader's equation? I'm going to put it up. Trader's equation. Risk, reward, probability. Okay, you control your risk and you decide how much to put in the market. Now, I come into the market every day. Now, this is my funds that I trade. I come with X% risk that I'm comfortable to lose on the day. And then I break that up into 4 pieces and decide to risk fractions whenever I want and build up my position. I don't put it all on one trade. So you manage your risk. Reward, like we're talking about where to take your profits, just sit 1-to-1 or manage it. Then probability is really based on your strategy. If you're really working on your strategy, you will know that with your strategy, if it's a trend strategy, then you are working on 60% probability of success, which means out of 100 trades, 60 you win and 40 you lose. And now we are into the second half of the year. You ought to have taken more than 100 trades at least so far in the 6 months. I mean, you should be taking maybe 200 trades. So now you've got enough results to go back. And if you just go on to your MT4 and run a detailed report from the beginning of January to end of June, and save that detailed report to tell you how many trades you took, to tell you your profit percentage of profitable trades, to tell you all sorts of things. That tells you how your strategies are working. So when I look at my probability, funny enough, I was looking at now, I'm not happy with, I was got a 45% chance, 45% profitable trades. And I am so unhappy because that's too high. I like to only win 40% of the times on my strategies because I'm trading reversals, which means that the probability of success is much lower. So out of 100 trades, I'm only going to win 40. The remaining 60, I'm going to manage the bulk of those to break even, and some I will lose at the original risk. But on the ones that I win, there's going to be huge acceleration in terms of profitability. But that's how I work out my probability. That's my strategy. Okay. So if you're a trend trader and you're only waiting for the trends to set up, okay, you're not worried about all of these reversals, etc. You're waiting for, like the trades that I showed you. I didn't show you. This was yesterday, actually. So a trend trader will say, I'm waiting for this kind of stuff. Market breaks out into a trend, then I want to trade it. Okay, a reversals guy, well, we want to take a trades up here before we know there's going to be a trend. We want to take a trade down here before we know there's going to be a reversal. Trend guys probably wait for these kind of trades. We want to take a trade that's higher risk, etc. So once you know that, then you start to manage your probability. You have to know that, guys. You really have to go back and that you got to manage. So be happy when the probabilities that you're seeing on this whole bunch of trades that you've taken are in line with your strategy. One thing that, goodness, 15 years ago or so, one of my early coaches said to me when we're talking about probability, he said, but listen, 6 months is gone in the year and you've only taken 20 trades. What's happened? So, my strategy said, no, there's nothing wrong with your strategy. You're just not taking the trades. He said to me, I need you, before you see me again, go take 1,000 trades. I said, that's going to take forever. I said, well, if you don't do it, then your coaching contract will be done. Okay, just go and take 1,000 trades. Well, I never got to 1,000. I got to 500. But whenever I saw the strategy, I started taking the trades. Okay, I dropped my risk, and I think I was only trading 0.25 and whatever it is at that particular time. You never lose money as long as you stick to your trade. But the picture starts to get clearer and clearer, and you can decide, hang on a second, this is how I actually want to trade. It's not going to happen until you've got the 10,000 hours, and that counts by you actively taking the trades, not take the trades in the market. Reduce your risk, and you're not going to blow up your account. Okay, so Aussie 200. So you could have taken that trade, and then now when you took those trades, you open and you're saying, there's a high of the double top, there's a low, I'm hoping to get down here. You took the trades and you get this acceleration and you're hoping for the market to get down here, and unfortunately the market turns. So when you see that failure, you gotta be saying, well, there's something wrong with this whole case for the bears. So while my stops for this particular trade were here, okay, I can now pull my stops down to break even when I'm seeing all of that. So stop is, when I say break even, to a technical level nearest to, and I don't just put a break even. So the nearest technical level will be here, which is almost break even, depending on where you got triggered. Okay, so you put it at the nearest technical level to your break even, which is that lower high. And then when you see that, if you are fast enough, you get out. If not, because of the gap up here, you would have been stopped out with this particular candle, which is fantastic because it's just a break even. Okay. Then the market creates another lower high here. And if you want to take that trade, that lower high, you know what to do with your stop, measured move. If you want to take the trade before the confirmation. Okay, broken above that, there is a turn. That's a stop. Nearest technical level is probably above here. I'll put it there. Or wait for the breakout, pullback, and lower high. So that's where you take another trade. Breakout, pullback, lower high. And if you're taking that confirmation trade, then your stop is here. Okay, if you're taking a trade here, then you've got to find where the measured move is in case there's another push up by the bears. Okay, so it's probably better always just to wait. Then market does leg one, leg two. So there's a bit of a wedge here that's been formed. Okay, micro double bottom. So the bulls that reverse the market here and the gap up are defending their gap. So when you see these, you got to be making decisions. That's the exciting thing about price action. I mean, it's been in the C-suite, and I've been there with all the boardroom decisions. This is just you and yourself thinking strategy, trade management, making decisions. Absolutely fantastic. So when you see the bears trying to break beneath his gap up, because the bulls were strong to gap up the market, but the bears are trying to break. First failed, second failed. So the wedge attempt, micro double bottom, higher low, you know, the bulls are taking control of the market. And if you're still in your trade, get out. Okay, a break even. So you're making decisions as you go along. So that's Aussie 200. Now you could pick any market that you want. Have a look at Hang Seng. Now this is quite interesting. Let's see if we can just clear in the next 5 minutes. I started talking about when a pattern fails and you had a breakout beneath it, you might get a measured move. So first candle, this is Hang Seng 50, first candle of the day, doji candle. Okay, so market closed down here. Bulls were strong enough to gap up the market. Bull candle at some stage. Bears came back in. Perfect doji. It's like, oh, hang on a second. If you're able to create a gap up, why do we have a doji? Immediately saying, well, possible trading range price action today. So at that point, measured move of our doji, that's a trading range. So if you get a breakout above it, would expect to get to that level. If we have a breakout beneath it, we get to that level. The 200 is a measured move. So the first attempt was an attempt to break above it, failed. Bulls tried to break out, failed. So bears had an opportunity here. Bulls came back again and failed again. This huge reversal candle here, an outside candle. Now, an outside candle is a trading range. You don't want to buy outside, beneath an outside candle, not buy, sell. However, if you want to do that, by all means, measured move, because it's an outside candle is a trading range, which means if you're doing that, your stop would have to be here. Okay, why? Because you might break out on the trading range and fail and trying to break up above it. So you put your stop there if you want to take that trade. Okay. Alternatively, you wait. So when I move this measured move out of the way. Alternatively, you wait. Now the bears come in and they try to break out beneath the trading range, the opening doji, but they themselves fail to even get to this measured move. Then the bulls resume. Now, when you see this, One of the patterns I'm looking for at the open is an expanding triangle. Okay, an expanding triangle is a breakout mode pattern, which means when I see it, I expect that there will be a breakout. So an expanding triangle would have so it's pretty easy to identify. So there's that low is the first point of the expanding triangle going down. At the same time, let's just mark it in red. At the top, there's the first point of the expanding triangle. The market comes down again. So you get to recognize this. The more you just kind of look at this in the market. There's a second touch, and I'm saying to myself, oh, this is good. If we have a third touch here with an expanding triangle bottom, if I get a 2-bar reversal, I expect acceleration up. But for you to have an expanding triangle, you do need, of course, to see the other side of it. So on the upper part, there is a second touch. At that point, you kind of maybe thinking, market might come and create a third touch here. So I've got 1, 2, I've got 1, 2. So as the market is going up, I'm thinking, oh, okay, I might get a third touch. If I get a third touch there and a 2-bar reversal, then we can sell it. But we don't get there. Instead, the bears sell off the market. Okay, so the top is failing. But let's see what happens to the bottom. At the expanding triangle bottom here, the third touch on this bear candle. At that particular point, you've got your calculators ready, you're working out where you could possibly put your stop, because you're saying, okay, there's an expanding triangle bottom. If I get a 2-bar reversal here, I'm going to jump into the trade and buy, in which case that would be the low of the expanding triangle. My stop would be here, so I can take that trade. But instead of an expanding triangle bottom and a 2-bar reversal here, the market fails. So this expanding triangle pattern has failed. You know, when a pattern fails, you know that now you're going to expect at least 2 legs to take place. Okay, so I'm going to expect a breakout. So the pattern has failed. There's no expanding triangle bottom here. So now I see a bear breakout. I say, okay, fantastic. Because of this pattern that has failed, you just got to wait to see where I can jump into the market. Then you can be a little bit more relaxed and take trades as they come your way. So there is a breakout. Breakout pullback low 1 beneath this test of the EMA. Okay, your stop is above this breakout point, and you take that or that trade. Now, in the last 1 minute, I want to show you, I hope it's here, how it worked out beautifully yesterday. Okay, my charts have been cleaned up. Right. So the same pattern, I mean, that's quite interesting. Yesterday. Okay, expanding triangle bottom. And there was the actual expanding triangle bottom. We didn't get the reversal. Instead, we have a breakout beneath that. Okay, so the expanding triangle bottom has failed. Breakout, fantastic. I got a way to see if I get an entry in. I didn't get an entry off here, but eventually I get an attempt to test that breakout point. So you could have taken a trade here. I mean, it just became so beautiful yesterday. And kind of say, oh, it's worthwhile waiting for this. You could have taken a trade here. You could have taken a trade here. Okay. Or you could have waited for a lower high, taken a trade here, taken a trade there, breakout, pull back, taking a trade, I mean, yesterday was just a gift, but that started from this failed pattern here. And it's the same kind of thing that we also saw here. Okay. All right, guys, we are spot on time and we'll catch up again next week. I haven't had time to put the links in, but I'm going to put them in on our Telegram groups. So just have watch out on the Actions World Telegram groups. You see the links to Wednesdays at the Market with George next Wednesday. 4 hours with 3 sessions, 3 opening sessions. Thank you, guys. And thank you, Marlon, for hosting the show. Bye-bye.